Well, good morning, everyone. My name is David Moore. I'm with IRA Advantage. Thank you for joining us this morning. And today's webinar is the Self-Directed IRA Bootcamp. I've attempted to get it down to an hour. We'll see how we do. And my objective in today's class is to get everybody out there comfortable with the concept, teach you how to get started and how it works, and probably confuse you enough to the point where you need me. But it's really a pretty simple process, and it's one of those things that's just a very well kept secret. It's possible to self-direct your retirement accounts from inception of retirement accounts, so it's not something new. It's just something that's been out there and hasn't, like I said, it's a well kept secret, and I like to keep it simple. So it's one of those topics where it's easy to get in the weeds. Before we were in the business, a couple decades ago, I'll never forget sitting in a class all day long, and one of the trust companies was giving it, and they had a couple CPAs talking, and I walked out after a day not really knowing how to use the thing. I understood how to buy what they were trying to sell me, but I didn't really understand what I could or couldn't do. So we put IRA Advantage together as a result of a couple decades of our 1031 clients wanting to do this and not knowing how to do it. We'd go through, after we figured out the ropes, we'd tell them all how to do it. And I'd ask them, a couple months later, well, how'd it go? Did you do it? No, I didn't do it. Well, why didn't you do it? My tax people said I couldn't do it. My legal people said I couldn't do it. My financial advisor said I couldn't do it. And really, when you get down to the bottom line on it, there's just so much misinformation out there. But we're going to dispel that. We're going to go through the basics of getting it set up, what kind of accounts work, the basic do's and don'ts, and I'll probably compare and contrast, give a little color between IRAs and 1031 too, because some of my earliest exposure with the IRA stuff was a gentleman that was sort of pushing self-directed retirement accounts in lieu of 1031. They're two totally different things, apples and oranges, and there's benefits and pitfalls to each. And there's actually situations where we would actually even do a 1031 exchange for somebody that has a retirement account, and we'll explain why that might be the case in a while. But if you, a little housekeeping on the right, there's your menu bar. There's a section on questions. As I said, we've got a full hour, so I'm going to go through stuff. If you've got questions and I see them, I have time to address them, I will address them during the presentation. If we don't get to it during the presentation, we'll be following up afterwards, answering any questions that people have. So the only dumb questions one you don't ask. If you got questions, please send them out there, and we'll do what we can to address them. And without further ado, we're going to get started today. So once again, I'm David Moore, and my background actually is real estate investment. And my brother and I grew up in Santa Cruz, moved to Oregon in 1990 to buy property, and shortly thereafter put Equity Advantage together, handle exchanges, 1031exchange.com. And that was a result of nobody really in the space out here doing exchanges. So we filled that need. And then, as I said, during the ensuing years with the retirement side, we were addressing so many questions on that front too, and just wasn't that much available information out there. So we put IRA Advantage together to handle that part of the business. So we've got one other thing. If you've got properties that you're interested in getting out of or getting into, or you're looking for something, during the 30 years in the exchange business, we had lots of people that used to throw properties at us all the time. It's hard to keep track of them. So we put a website together, post 1031, and feel free. It's free to list stuff. There are paid posts too, but that's nationwide properties. Anybody can put it up there. And the nice thing about it is, if you've got sort of like pocket listing, something where you don't have total control of it, you want to get word out, there's a haves and wants section there too. But let's get going. And once again, the topic, Self-Directed IRA Bootcamp. So as the title implies, we're going to get going from the very beginning of the topic and then get you into how to do the basics of it. If you've got more complicated questions or concerns, we'll probably address those in more advanced classes. But once again, this is the starting point. And hopefully you'll get a lot out of it. And even if you get a little, I call them nuggets of knowledge, one little thing out of it, it'll be worth your while. So I said I'd keep it simple, the old KISS principle. If you were talking about a tax deferred exchange, and if you've been to my webinars or classes on 1031s, I break it into 4 basic cornerstones. It's got to be an exchange. What's going to receive have to be of like kind. For total deferral, you need to go across or up in value and equity. And finally, we have to have continuity vesting. The taxpayer that relinquishes has to receive. Obviously, there's a lot more to it than those 4 points, but those are the main concerns I've got in a 1031. Time's always the biggest headache. Vesting's the next biggest issue. When we look at a retirement account, really it's 2 issues. What do you want to buy, and who are you transacting between or for the benefit of? And as I said, this is not new. Retirement accounts came into play in the mid-70s. It's always been possible to invest in real estate and other items that are not Wall Street offered. It's just one of those things that it's appeared to be too complicated. And honestly, a lot of times, if we're looking at just a basic self-directed IRA, getting the trust company involved with everything, it can be sticky, it takes time, it's cumbersome. So checkbook IRAs, and we'll talk about a checkbook IRA in a while, really simplified that process. If you're self-employed, let's say you're a real estate broker, self-employed with no employees, I'm not going to use an IRA for you. I use a solo 401k. And once again, this class is not aimed at selling the people on the call. If you're a professional in real estate, I'm not doing this to sell you guys a retirement account. I'm just saying, hey, if you've got somebody that's looking at the economic situation right now, and maybe they're starting to see where, hey, cash is king. Those with gold are going to make the rules. You can see where the markets are changing a little bit as the property starts having some issues. We're going to have situations where maybe we have to use a retirement account to save a property. Maybe we have to use a retirement account to make the investments you want to make. Maybe you're putting a self-directed retirement account to make a loan, buy a note. Any of those things are all possible, and we're going to talk about how you do that stuff. But the bottom line is, there's opportunities out there. There's always opportunities. Anytime the market goes up or down, you're going to see some opportunities out there, and we're going to teach you how to do it. And it's not that complicated. It's just not that complicated. Those 2 issues. What do you want to buy? Who are you transacting between or for the benefit of? Those are my 2 big concerns. So, well, what is a self-directed IRA? It's not a legally defined term. It's just a term that describes an account that allows you to go buy what you want to buy. And if you look at it in the most basic sense, it's no different than any other IRA. You're just changing. You're moving from a custodian that won't allow you to buy what you want to buy to one that will. And obviously within the law's limits. But that's all we're talking about. Moving from a custodian that won't let you do it to one that does. That's all that's involved. If we're doing a checkbook IRA, we're just sticking an IRA-specific limited liability company directly between the trust company and the ultimate investment. If you've got a 401k plan that doesn't allow you to go out and buy gold, silver, real estate, notes, make all those self-directed investments, it's not a restriction in the law. It's a restriction in that document. It's a restriction in that plan document. So when we're looking at 401k plans and making them fit something, really first thing we're going to do if somebody calls up with a 401k plan, asks if we can do something, we're going to say, okay, we want to see the plan, see what it does or does not allow. And if it doesn't allow the investment that person wants, well, next question is, can we amend the plan to allow that to happen? If we can't amend the plan, then we're going to maybe replace the plan. But really, as I said, any restrictions you've got on investment or your clients have on investment in today's context is really custodial related or plan related. Any IRA can be self-directed. 401k plans, we've got some issues. If it's a current plan, current employer plan, and you're under 59.5, we're pretty much stuck. Keep in mind though that COVID has brought up an opportunity. The CARES Act actually has a provision in there talking about your ability to borrow up to $100,000 from your retirement account, and that's really, it's going to be there until September 22nd. You don't even have to make a payment the first year. After that, it's going to be paid back as any other IRA 401k, not IRA loan, but 401k loan. And you have to get it back in. If you don't get it back in, you're going to have tax exposure on those funds being pulled out. But if you're in a situation where you need some help on something, you want to get started, maybe you were laid off, you want to even do a new business, maybe that $100,000 that the CARES Act offers you is going to take care of you in that situation talk to your tax people about it. If you got questions, give us a call. We're happy to help you with that in our last newsletter. If you're not on our newsletter list and you'd like to be, email us and we'll get that thing out to you too. The last newsletter covered the CARES Act and this 100,000. But it's a great opportunity, but it's fleeting quickly. Like I said, the 22nd of this month's the last day you can do that. So if you got questions, talk to your tax people, talk to your administrator, talk to your custodian, and you give us a call if you got questions on that. But that's a huge opportunity right now, and it is going to be going away. So why a self-directed account? Why would you do this? And really, it's simply because you want to diversify beyond Wall Street's offerings. That's why you're going to do it. It's just further diversification, and it's not all or nothing. You don't have to do everything. You don't have to move all your funds. I'm going to tell you, use what you want to use in that self-directed capacity. Move that money, but leave the rest of it where it is at Wall Street, because you want to, if we're talking IRAs, you want to separate those accounts, because if you commit a prohibited transaction with a self-directed IRA, you're going to in effect distribute all funds in the account as of the first day in the year in which the indiscretion occurred. So obviously that's not a good thing. 401k plans a lot more liberal. Only the money involved with the indiscretion is treated as distributed. But the bottom line is you keep your Wall Street stuff in the Wall Street account. If it's with Fidelity, Schwab, whomever it might be, keep your Wall Street stuff in that account. Move what you're going to use into the other self-directed IRA. If we're talking 401k funds, you don't need to do that. Obviously, everything will just go into the plan and it'll be taken care of. But why do people do this? They're tired of the ups and downs, the whoop-de-doos. I mean, if you look at the stock market right now, it's been pretty crazy. You look at it this morning, it's down 800 points after record high yesterday. So it's just all over the place, and sometimes people just need a break from that. Tangible assets typically are going to be less liquid, and typically people look at that. If we're looking Wall Street world, they look at that lack of liquidity as a problem, but I'd say in a lot of ways it's not. In a lot of ways it's a good thing, because it gives a much more stable ride during the time you own it. The one issue that I would bring up, and it's going to be covered in a couple pages later on overcoming objections, is that since it's not liquid, if we're in a point where you've got to take a RMD, required minimum distribution, keep in mind they went to 72 from 70.5 this year. But if you are in a situation with a self-directed account, and let's say it's a checkbook IRA, for example, and you're in a situation where there's no cash in the account to take the RMD, you simply assign a membership interest in that checkbook IRA LLC, or maybe do an in-kind distribution of the assets that IRA checkbook IRA LLC has. But in-kind distributions aren't a problem. They're actually quite an opportunity for a couple different reasons, and we'll talk about that a little bit further in a while. Greater financial control. Invest in what you know. Think about this. If you've got specific knowledge of something on Wall Street, can you legally use that? Unless you're in the House of Representatives or a senator. They've had some issues there, and they have a different set of rules, and that's sort of been kicked back and forth. But the bottom line is, for the general public, you can ask Martha Stewart about this. I always use her as sort of my example. I'm not her biggest fan, but I'll tell you this, she's certainly not the biggest culprit in insider trading, and she took a fall for it. If, on the other hand, you're in the self-directed world and you're a mortgage broker and you want to take your retirement account to make loans to people, can you do that? And the answer is yes. If you're a real estate broker, you want to go out and buy real estate. You probably have better knowledge of things than the general public. Can you legally do that? The answer is yes, once again. So why not reduce the risk by investing in something you know? Increased investment flexibility. Obviously, you're going to go out and get whatever you want. The real investments, not alternative investments comment. I say real estate's a real investment. I always capitalize REAL, because for some reason, anything real is considered an alternative investment. If you look at the pictures on this page, we've got gold there, and gold also is considered an alternative investment. Real estate is, how did these things, the oldest investments known to man, get considered to be alternative investments instead of, they are real investments? What got us in that problem, the last crash? Synthetic derivatives, what are they? That's not considered an alternative investment, but what we're dealing with is crazy, crazy stuff. Community-based investing. You want to make a difference where you live, you can do that. Invest in the stuff around you, invest in what you know, invest in the stuff you can see and make a difference in your own community. That's a pretty powerful situation, a nice opportunity for people. Take advantage of today's opportunities. Obviously, we're looking at it a lot. Anytime we're going through turmoil like we are right now, we have an increase in that retirement side of our business. I think this time it's been a little bit different because of that 100K situation with the CARES Act. But we're going forward. It'll be interesting to see how things go. But taking advantage of today's opportunities, you've got cash to go do stuff. Most IRA investments are cash. Most 401K investments are cash, but they don't have to be. They can be leveraged. It's just got to be non-recourse debt. Tangible assets, like I said, great hedge against inflation. We all hear the ads. We all see the ads. I mean, when was the last time you saw an ad for gold? Probably this morning. But the thing is, you buy gold, you're betting that it's got to go up to make you money, right? And with real estate, it doesn't have to go up to make you money. If you buy a note, somebody's paying down that note. So you're not betting things are going up or down. I was taught never to bank on appreciation, but the great thing about real estate is typically it does appreciate. So that's just another positive there. Security, it's just security component is just further diversification. Giving a more diverse investment portfolio is going to help you out, and any investment advisor is going to tell you that. So I said 2 issues. 1, what do you want to invest in? 2, who are you transacting between or for the benefit of? So this is the number 1 piece. You can buy with an IRA literally anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. Literally anything other than that. It's wide open. All right. Any purchase just simply must be for investment purposes. You can't buy something for personal use. You couldn't buy a place at the beach and use it. You couldn't buy some business and go work in it. Now we've got a solution for that, something called a rollover business startup. The acronym's sort of unfortunate to Rob's. But you just have to look at it and say, okay, by law, the way the code works, if it's not specifically prohibited, it's therefore allowed. Real estate in the context of today's presentation is not prohibited, therefore it's allowed. Collectibles, life insurance contracts, stock in a sub-S corporation, that's it. 401K plans can buy literally anything other than collectibles, so it's even more flexible with 401K plans than it is with a self-directed IRA. So 1, what are you buying? 2, who are you transacting between or for the benefit of? If you transact between or for the benefit of a disqualified party, you've got a prohibited transaction. So the question is, who's a disqualified party to your plan? And well, you are, your spouse would be, parents, grandparents, kids, grandkids, their spouses, sorry about that, or any legal entity owned in a controlled interest by one of those. Those are all disqualified parties. So when we're looking at this stuff, real estate, what can we buy in real estate? We can buy all kinds of things as long as we're not going to have a personal benefit to it. So if we look at an office building, can we buy an office building? Yes. Can we buy an office building to occupy? No. Why? Because there's a benefit to you. You're a disqualified party. Even if you have, let's say your business was some type of corporation, if you have a controlling interest in it, therefore we've got a problem. If you've got a minority interest, then it may be possible. That's a conversation we can talk to you about. But any transaction between or for the benefit of one of these disqualified parties would constitute a prohibited transaction. As I said, with an IRA, you don't want to commit a prohibited transaction. If you do, you've got a major problem there because you're going to have full distribution of all funds in the account as of the first day in the year in which the indiscretion occurred. That's a big ouch. You don't want to do that. So keep it away from the kids, all the family, any other entity you've got a controlling interest in, and you're going to be fine. And what we're talking about is buying from, selling to, loaning to, borrowing from, any personal use of what's going on with that asset would be considered a prohibited transaction. You can do the administrative functions of management, but you can't go out and work on these properties either. So if you're a disqualified party, you can manage the asset, but you can't go out there and we say get dirty on it. We don't want you out there pounding nails. So what kind of real estate qualifies? As I said, that office building's not going to work if you're occupying the office building. What can we buy? rental houses, apartment buildings, office buildings, retail centers, land, any real property to be held for investment. Even a future retirement home, you could buy a property, and a decade from now, you could take the property as a distribution and move into it. Now it'd be fine. You can't use it, period, until it's been fully distributed. But that's something we have a fair number of people do. They buy something that ultimately they fall in love with. And I'm not talking about moving into things. A lot of times it's just investment properties, and they ultimately want to personally own it, and that's totally fine. We can do that. So the big no's are primary residence, a second home, a home for a disqualified party, an office building to be used by a disqualified party. So you can't buy a condo for mom. You can't buy a rental house for Junior to live in while going to college. That would be a problem, because Junior's, your son would be a disqualified party to your plan, just as you are. So we just have to look at that, look at what you're buying, and look at who's going to be benefiting from it, and that's where the issues are. One question that comes out a lot is, well, I'm pulling money out of my retirement account to go do this stuff. And you're not pulling any money out of your retirement account. You're just moving from custodian A to custodian B, or changing the plan. So the plan or the IRA is going to be the owner of the asset. If we're talking a basic self-directed IRA, really the trust company is going to be the deeded owner for benefit of your IRA. If we're talking about a checkbook IRA, then we're talking about that IRA LLC that's going to be the owner of the asset. Our clients typically the manager of that LLC, the member is the trust company for benefit of the IRA. But that's what we're looking at. If it's 401k plan, the plan's going to be the owner of the asset. Prohibited transactions. As I said, prohibited transactions occur when there's some benefit to a disqualified party or transaction between disqualified parties. So you could not sell to your IRA, could not buy from your IRA. You can't loan to or borrow from your IRA. You cannot, as I said earlier, any debt on an IRA 401k owned asset's got to be non-recourse. You cannot personally guarantee that loan. You could not be a co-owner. You can be a co-owner of the asset, but you cannot be a co-owner and guarantee just your portion of it and have the plan portion non-recourse, because the plans or the IRA's benefiting by your getting that loan and putting yourself on the hook on that, even if it's a personal owned side. And you can own property jointly, either via tenancy in common or via common membership in an LLC. Either way is going to be fine. But any of these things are going to constitute a prohibited transaction. In addition, people call up, they want to flip properties using an IRA. Two issues there. One, flipping property is a business, so you might get away with one or two, but at some point it's a business. You're going to be subject to unrelated business taxable income on that. Even with a Roth IRA, you're going to at some point. So you've got to be aware of that. Two, you cannot work on those properties. So as I said, you can manage the thing, you can't get dirty on it. I don't want to hear about you out there pounding nails, picking up the paintbrush, doing work, all that. Don't do it. That constitutes a prohibited transaction. And a lot of times people ask, well, how do I get caught? And the way you get caught is by getting audited, and then they look at the ledger off your retirement account, and all of a sudden you've got an invoice to Sherwin-Williams for $1,000 for paint, and they want to know where the corresponding labor invoice is, and your answer is going to be what? Can't be you did it. Did your tenant do it? Who did it? So just our position is you've got to be careful, be conservative with this stuff. Don't put yourself in a situation where you're going to have a problem. And honestly, a lot of our 1031 clients, when we put retirement accounts together for them, they'll say, when I tell them they can't work on it, they're sort of relieved, because it's an excuse not to do the stuff they have for decades done on their income properties. So it's not entirely a bad thing. It's an excuse not to do that work. But as I said, you're not the owner. A misconception is people think they pull money out of the plan, they think they own the asset. You don't own the asset. That asset is owned by the retirement account, period. So any benefit that thing gives is it. So for example, cash flow on the property, you go buy an income property, the cash flow on it's just going to go back in the retirement account. The only way you're going to benefit is by a distribution at the end of the day. So you're going to keep things going. Inside, what is in it until you pull it out as a distribution. There's not going to be any personal benefit to these assets during the time they are inside the IRA or 401k plan, period. So how do we do these? How do we create them? As far as corporate plans or 401k type plans, anybody under 59 and a half with a current plan is going to be stuck there. As soon as you hit 59 and a half, you can take an in-service distribution. Previous employer plans we can work with, but if you're happily employed and it's a current employer plan, you're probably stuck. But then on the other hand, think of COVID right now. So you've got probably lots of people out there that have been displaced and maybe don't have a job right now. Maybe they have access to this plan and they're going to have a choice. They go get employed again. They can roll that plan into the new plan, the new company's plan, or they could self-direct it or shove it in any other type of IRA. I would encourage you to just put it into an IRA. That way it's up to you to do what you want with that pile of money. You don't have to have it stuck back in the plan until you're 59 and a half, period. So when we're looking at corporate plans or any sponsored plan under 59 and a half current plan, then we're stuck. Over 59 and a half in-service distribution, get access to it. Any IRA can be self-directed. So we do have some restrictions if we're moving, let's say, IRA funds into a 401k plan. We can't move a beneficiary IRA, one that's been inherited. Can't move Roth funds into a new 401k plan. But as far as IRAs, we can create a self-directed IRA with any type of IRA. Anything can be used. So how do we do it? Okay, for that, remember back at the beginning, I had that, I think the first page, we talked about the two issues. What am I buying? Who am I transacting between or for the benefit of? That's what we're concerned about. So how do we put this thing together? How do we make it work? If we're talking about a basic self-directed IRA, all you're going to do, and most custodians are going to have applications on the line, and you can just go to that website and fill out the application, and you'll have yourself an account. If you want a checkbook IRA, those custodians are not going to work with you. You're going to have to go to an IRA facilitation company, somebody like IRA Advantage, and that's what we do. If we're talking 401k plans, we can put those plans together, but we're looking at IRAs. We're not a trust company. When we put the business together, we've thought about doing that, but it's in a nutshell, it's a bank. And the custodian that we use charges our clients about $280 a year. So the math didn't work. So we said, the heck with it. We're going to do what we do, which is create investment vehicles and give it, direction on how to get from A to B. And we're going to let those trust companies do what they do, or the custodians do what they do. And so when we're looking at this, you can go online to any number of self-directed sites. As far as the big ones, you probably have heard of Pensco or Equity Trust, Sterling Trust, SunWest Trust. IRA Services is one that we use a lot. They just changed to Forge Trust 2 weeks ago, but there's a bunch of them coast to coast, and a lot of them have been doing it a long time. Some of them have been changing hands a lot recently. But the one thing is that it's a little tough to get information when you're calling into those places, especially in the times of COVID, because a lot of people are working from home, getting things going. So don't expect the creation of one of these things to go fast. People ask me how long it typically takes. I tell them 2 to 4 weeks. It's really just a question of how quickly the money can get moved from A to B. That's what's going to take care of it. So anyway. If you're working with us and you want to put let's say a checkbook IRA together, you're going to fill out our applications, 2-page application. Really, that application just asks about you. It asks about what type of accounts you have, who the beneficiaries are, what you'd like to invest in, what the source of funds are. If we're talking a checkbook IRA, we're going to want to know a couple of LLC names. And when you're coming up with those limited liability company names, a lot of times people say, well, gee, the first one they come out with is something about their name or something with IRA 401k. Well, we don't want your name in it because we want you to make sure if you've got a checkbook IRA, anytime you pull that checkbook out, we want it totally clear this is not you. You got to look at it. No, you don't want to pull it. If you got a debit card for that account, you don't want to pull out the wrong debit card going through McDonald's and for $10 blow up your retirement account. So we really want a name that's going to be something that's really clear to you. This is not you. This is your retirement account. You're going to be cautious with that stuff. The reason we don't want IRA or 401k in that name is when you go to the bank to open the checking account for that limited liability company, if it's got IRA or 401k, first thing they're going to do, or anything with retirement retirement, they're going to send you off their trust department. You have nothing to do with their trust department. If we're talking a checkbook IRA, all you're going to do is open a checking account in the limited liability company's name and federal tax ID number. The member of that limited liability company is the trust company for benefit of your IRA, and you are the manager of that entity. So as manager of that entity, soon as you're going to get that bank account opened. As soon as it's opened, we're going to be able to get that thing funded. But you're really going to fill out that information, get it back to us along with your most recent copy of your current account statement and a copy of photo ID. We're going to put things together, and the money's going to move from custodian A to custodian B, or from 401k plan to custodian, or plan to plan, or IRA to plan. One of those two things is going to happen. And then depending on what type of account we've got, we're going to move forward from there. But it's not a hard thing. It's not all or nothing, like I said. You're just going to move what you want to use. And this is not a hard process. It's going to take some time, and it can be confusing at times, but you're just moving what you want to use from custodian A to custodian B. So a basic self-directed IRA is a situation where we've just established the new custodial account with the custodian. The money is now in that account, and that account is going to make whatever purchase you want to make. So the deeded owner, if we're talking real estate in a basic account, is going to be the trust company for benefit of your IRA, or it could be any combination of different accounts and all. But I mean, if it's a basic, it's just going to be the trust company for benefit of the IRA. If we're looking at a checkbook IRA, this bubble chart is a checkbook IRA LLC. So you're going to see, if you've looked online, you've probably heard of a checkbook IRA, or you've heard of an IRA LLC. And what happens in this scenario is we're going to, no matter what type of account, we're going to create that new custodial account if we're talking an IRA. The money's going to move from whatever source it is into the new custodial account. You might have traditional funds and Roth funds. And while we're on that topic, so everybody's on the same page, a traditional IRA just means pre-tax money growing tax deferred. You're going to pay normal income tax on distributions at the end of the day, where a Roth IRA is tax money that's going to grow tax-free. Now, just because you have a Roth IRA doesn't mean everything you do is tax-free. As I mentioned earlier with the flipping of properties, that's a business, not investment. You're going to have tax exposure in that situation. The other situation that wakes people up with IRAs and leverage. So, for example, if you go out and buy a property with an IRA and it's 50% loan to value, half the income and half the gain is going to have tax exposure. So any income or gain attributable to other people's money has tax exposure, and that's with a Roth IRA as well. So don't think you can, get away from that because it's a Roth. You're still going to have that tax exposure. Now, what's interesting is 401k plans, you don't have that. You don't have tax on leverage, but the IRAs you do. So be aware of that. So we're going to move whatever type of accounts into the new custodial accounts. We're going to create them, and that might be, just a traditional. It could be a traditional and a Roth. It could be your account, the traditional Roth, and your spouse's account. All those things. It could be personal money too. But what's going to happen is, instead of the custodian or the trust company going to buy the ultimate investment, they're going to make an investment in this new LLC, which has you as the manager. So as soon as the trust company makes the investment into that limited liability company you're the manager of, you're going to have a bank account in the LLC's name and EIN. The bank account, that investment the trust company makes, funds that bank account, and you're the manager of the LLC. Therefore, you're going to be signer on that account. And for you to go out and buy a piece of property, you're just going to negotiate the deal's purchase in the LLC's name and write a check. And when you go to buy the property, you're going to write a check. Any income off the property is going to go in. Any expense is going to be paid out of that LLC. You want to do a loan, same thing. It's just going to be between the borrower and your limited liability company. Whatever investment you're going to make is just going to be in that LLC's name. So a checkbook IRA LLC is one of those things that really unlocks lots of opportunities that a basic account does not, just because a basic account's so cumbersome, where a checkbook IRA, and actually it can actually save you money in some situations when you look at a number of transactions all being handled through different trust companies. There's charges every time there's money in or out of those accounts, where with the checkbook IRA, as soon as the investment's been made in that LLC's bank account, your only interaction with the trust company is to provide them a valuation of all cash and assets that the LLC has annually. That's it. So they're really attractive. You got to be aware of what trust company you're working with, though. So earlier I mentioned, what I did or did not like with respect to charges, and I don't like, a situation where my client's being charged on the value of the account because they're adverse to the trust company. And during the last crash, I had a client with $1 million note out of Chicago that was worth nothing, and the trust company kept trying to charge him based upon $1 million value, and until he got the actual default taken care of, finalized, they were still trying to charge him that way. So I'm really adverse to that. As far as the second factor, you really have to understand with trust companies, if you're looking at checkbook IRAs, you need to know what that trust company is going to require, because all these trust companies are set up for self-directed IRAs, obviously. But when we're looking at checkbook IRAs, some don't like checkbook IRAs, some have different sets of rules, some are concerned about them. For example, sorry, I'm stumbling. Equity trust at one point wouldn't allow the taxpayer to be manager of the LLC, which totally defeats the entire purpose of the checkbook IRA. We had another trust company that was would not do the checkbook IRA unless your tax or legal counsel signed a document stating they're experts in all things IRA, which most tax or legal people don't want to do unless that's what they do specialize in. IRA Service, which is now Forge Trust, they've got a review requirement. So they want you to tell them that there's going to be a third-party review of the LLC's activities annually. That review could be done by your attorney, your accountant, or we as the organizer can do that review. If you want us to do it, I believe we charge $180 a year to do that review. And it's not turned into anybody. You're basically just saying, hey, look, this is being done. They want to know it's being done. They want you to know somebody's looking over your shoulder. So you're going to be more careful with this stuff. Because, as I said earlier, a checkbook IRA, even a basic self-directed IRA, if you've got a Wall Street offering, yesterday I was on the phone with a couple of financial advisors we're working with, doing some accounts just for further diversification. We were talking about this. I said, look, anytime I've got clients, diversifying funds further into the Wall Street, out of the Wall Street into these self-directed accounts, I want to make sure that we're, compartmentalizing these things, keep the Wall Street stuff in a separate account when we're looking at IRAs, because I don't want everything being encumbered in a prohibited transaction. But even if you have a basic self-directed IRA, you can have a problem. Checkbook IRA is you literally have the power of the pen. If you want to go buy a hamburger with that checking account, you can do that, and you just blew up your entire IRA. So you have to be diligent to do the right things. Make sure you're staying on top of this stuff, because literally with a checkbook IRA, your only interaction is annual valuations. Beyond that, nobody's overseeing what you got going on. And people ask all the time, like I said earlier with that paint example, how do I get caught? Well, you get caught, you get audited, and somebody's going to make a problem for you. And what's really interesting to me is I've been doing handling exchanges for 30 years, and rarely do I have clients come in. Well, I might have a client for 20, 25 years, and all of a sudden they come in, they want to do a retirement account with us, and so all of a sudden they're in here talking. And I said, well, look, we've been handling your deals for 20, 25 years. I've never seen you. Now, why are you in here now? And they said, well, this is different. This is my retirement account. I said, well, what's the other money? So I just, in general, people with retirement accounts, I'll say this: if I were a bank looking at non-recourse loans, I would be very interested in them. They're lower loan to value. Typically, they're going to be a little bit more money, and you're dealing with people that have had the wherewithal to put the money in the accounts. I mean, these are responsible people. They don't want to lose that money. So, I think it's my experience with this side of the business is people are just more conservative with it. They don't want this money to go away, and when they come to us, typically they're wanting to diversify just for more safety. Once in a while somebody will do some business startup or something that's more aggressive, but that's not typically the case. Typically they're just putting things into things that they feel good and strong about, and it's just further diversification. So as I said, this is sort of one of those fallacies out there. People say, well, you can't leverage an IRA. Totally untrue. It's just got to be non-recourse debt. And what I mean by that isn't default. The only thing the lender can do is take the asset. They can't do anything else. Can't come to you. You're not going to get the loan based upon your income, credit, and whatever assets you've got. You can't guarantee that thing. So In a default, the only thing the lender can do is take that asset. And so if you're looking at the residential type loans, if you look at myiralender.com, iralending.com, sites like that specialize in it. North American Savings Bank's got a nice book, a guy named Matt Allen wrote, and it'll talk about all that stuff. But if we're talking 4 units or less, you're not going to get these loans from your regular mortgage broker unless they've got access to these non-recourse loans, because these are not things that are typically sold. They're a portfolio type loan, meaning the bank's going to place a loan and keep it in their portfolio. So as I said, it's going to be a little bit more money, typically lower loan to value. Think 60-65% loan to value probably at most. And another reason to keep it at that level is just that next bullet with the UBIT. I mean, you've got leverage. If it's 50% loan to value, half the income is going to have tax exposure and half the gain on disposition. So you've got to look at that stuff and understand what's there and what kind of loan. If we're looking at the commercial world, obviously there's a lot more non-recourse loan access that in that space. Just be aware of the bad boy carve-outs and some of those. Sometimes they want to stick you, if there's some type of fraud or other thing going on, then they can come back at you, and we would really encourage you to steer clear of any of those things too. But the most important thing to understand is, yes, these loans are there, and but you're going to have to look for them, and there's going to be a lower loan to value. What are common objections? So as I said at the very beginning, I'd ask somebody, they'd ask me how to do this. I'd tell them, they'd come back. I'd 6 months later ask them how it went. Somebody, well, so-and-so I couldn't do it. So-and-so I said I couldn't do it, da-da-da-da-da. These are the objections I see over and over again, all right? So loss of long-term capital gains tax rates. Why would you take your money out of, or not money out of, see, even I say it once in a while. Why would you take your money and roll it from your traditional IRA into a self-directed IRA to go buy real estate when you're losing the long-term capital gains tax rates? And I actually went to a presentation one time and a CPA spoke, and I talked to him about it afterwards. And I said, well, why do you think using that money to buy real estate's a bad thing? And I swear he'd been to some CE on this, and they went down this list. Well, loss of long-term capital gains. You're not going to get long-term capital gains. You use the IRA 401k to go buy the real estate. Okay, so what are you going to buy with your IRA 401k plan that's going to give you long-term capital gains tax rate? That's a pointless statement. It's meaningless. No matter what you buy, it's going to have the same tax consequence. So really, if you're looking at this stuff, it's simply a question: what's the highest, best use for that money? Second, cannot be leveraged, as we just talked about. Totally wrong. You can leverage anytime. Private money, so seller financing is always going to be there. That's probably the best way to go about it. But other than that, it's just got to be non-recourse money. So that's a totally incorrect statement. What about RMDs? I made a comment earlier about that as an objection. And yeah, it can be a problem. If you get to 72 and you don't have any cash in your account, you need to take an RMD and there's no money there to do it, you would pay a penalty. But you don't have to take a cash distribution. And this is something I find very interesting and helpful to a lot of our clients, because the bottom line is, if you take $10,000 cash distribution, you're paying tax on $10,000. Now, the upside is you got the money to pay the tax. You take an in-kind distribution. Number one, what's it worth? Number two, if it's a minority interest distribution, you can discount that value by up to 40%. So you can accelerate distributions while minimizing the tax consequence by taking in-kind distributions instead of cash distributions. What's the downside? You're going to incur tax liability without receiving the cash to pay the tax obligation. And it's sort of interesting. The other day, I was talking to somebody talking about buying acreage with timber on it. And we talked about this because the guy hunts too, and he said, at some point I'd love to own the property and be able to go out and hunt on it and do everything else I want. I said, well, this is what we ought to do. We're just going to buy, set you up with the account. You can go buy that land and hold it. And then when you decide it's time to take it out, take it as a distribution. Let's take it out over a couple different distributions, minority interest distributions, so we can discount that. And then that property will be yours. And well, it's land, so we can't really source of funds a lot of times to pay the tax obligations, the cash out refinance of the property after you've taken it out. And obviously with land, that's a tougher deal. But in his situation, it has timber. So what's he going to do? When he takes the property out, the tax liability will be covered by the sale of the timber on that land. So I just think that's a great solution. In his situation, I think it's a great opportunity for him, and he's going to do it. But when we're looking at loss of, or what about those RMDs, there's always a way. Just got to look at how we're going to do it. And what a lot of times is looked at, pointed to as a problem, is not a problem. It's actually a tremendous opportunity. Finally, lose interest deductions, depreciation. Well, once again, what else are you going to buy with a retirement account that gives you those things? And really, if you've got a leveraged investment, so think about like 1031s. And you pull money out of your pocket, go buy something, you're always looking at basis and gain, what's happening in there. When we're talking about retirement accounts, and actually 1031, we're looking at basis and gain, looking at capital gains rates and what we're going to do with it. You do an exchange, you kick the ball down the road. IRAs, 401k plans are like automatic 1031s. You're automatically kicking the ball down the road. But at some point, the problem with a retirement account is the money has to come out. So how are you going to get it out with the least possible tax consequence? When we're looking at deductions and depreciation, typically if you go pull money out of your pocket, go buy a piece of property, you've got those things you're going to be doing. If you've got a leveraged investment with an IRA, your tax people might actually do that. They might take some of that, and remember, it's your IRA. It's not your property. It's the IRA's property. Therefore, as far as the insurance on the property, it needs to be a policy that's not your policy as an additional insured asset. It's got to be a new policy in that LLC's name, and it's going to be paid for by that LLC, period. So these 4 objections are typical objections. Each of them are not, worth the words I just used, honestly, but that's what you're up against. That's what people always point at. And it's interesting, the other day I had a closing with a 401k plan, and this is a woman that's had a plan with us for years, and we've got LLCs that we've done for her for the plan too, but she was going to close the property, and the title company was saying she can't close the property in the plan's name, it's got to be in the entity. And they just didn't know. So of course, we get involved and have to get it sorted out. But like I said, back to that comment earlier about no dumb question. If you need help on something, give us a call. Even if you're work with somebody else on it, if you're trapped, you're not getting help, give us a call. We'll do what we can to help you out. So 401k plans. I love 401k plans. When we're looking at the 401k plan and comparing it, a solo 401k, let's say you're a real estate broker, a solo 401k versus an IRA, I'm going to do the 401k plan any day of the week over the IRA, just because of the additional flexibility. You don't have to have a trust company involved. When we put a 401k plan together, they're self-trustee. So you're going to get the plan, you're going to get the tax ID for the plan, you're going to open a bank account in the plan's name and federal tax ID number. You as trustee have the power of the pen. So it's going to work just like your checkbook IRA does, but you don't have a custodian, you don't have the cost of the custodian, you've just got that plan. There's no reporting on it either if you've got less than $250,000 in it. As soon as you hit that $250,000 number, then you've got a 5500 easy that needs to be filed, and most of our clients do that on their own. If they don't do it, they just have their tax people do it. They're very, very nice to work with, and a checkbook IRA or a 401k plan, we charge around $2,300 to put those things together. Usually people use their plans to pay for those things. If they've got Roth money, they don't. Usually you're going to pull money out of your pocket because you've already paid the tax. But if it's in the plan, why not use pre-tax money to take care of that tax obligation? If we're looking at the other benefit of the 401k plan is you can borrow pre-post COVID. That CARES Act only covers until, like I said, September 22nd for the 100. But 401k plans, you can borrow half what's in it to a max of $50,000. You can't do that with an IRA. So that's one of those attractive things. You can buy life insurance contracts, S corps, You don't have the custodian, like I said, no leverage, you bid on leverage. But and think about this: you've got contribution limits up in the mid $50,000 range with sole 401k. It's like a a SEP IRA, a similar number, slightly higher, but they're very attractive and they work very well for people. So you want to go buy a piece of property, all right? We run radio ads. And we get calls all the time, and people visit our websites and they give us a call. Can I do this? Can I do that? And they'll ask how long it takes to get this thing. And number 3 says it takes 2 to 4 weeks to get this taken care of typically. So we'll go through all the do's and don'ts, talk to them about costs and all. When do you think I hear from the client? I hear from them when they've got that property that they have to have. Now, if you're the broker in this transaction, you're probably not going to be very happy with a basic self-directed IRA, because a basic self-directed IRA means that the deed is going to be in the trust company's name for benefit of the individual's benefit. Who can you write that offer between? Who's got the power of the pen for the trust company? You cannot have the taxpayer tie the property up, take it off the market, then assign it over. Even though if your purchase sale agreements are assignable, the individual tying it up for their IRA or 401k, that would be considered a prohibited transaction. You've taken the property off the market, therefore the plan or the IRA is benefiting, therefore it's a prohibited transaction. So, a basic account is going to be a situation where you've got to be careful on who you're writing the offer between, and you can't just assign it over. If you've done this, my advice is get rid of that offer, rewrite the thing correctly, and go from there. But, just got to make sure that it's set up, and make sure if you're talking to somebody, your first question is going to be, is the account set up and ready for them to make the investment? If the answer is yes, the next question is going to be, what type of account is it? And then if they say a checkbook IRA, you're going to love it. If it's, say, a basic IRA, you're not going to be very happy. That checkbook IRA works so well because it's just you're just writing the offer between the seller and that limited liability company, taking care of it. So it's additional contingencies here, and we want to make sure that one, you're asking for enough time to get it set up if it hasn't been set up. 2, if there's financing in there, the typical state forms on real estate are going to include some type of financial contingency on there, but it does not contain what is needed. It does not contain the non-recourse verbiage that we want to see for an IRA or 401k plan. So we wanted something specifically stating that. The other issue that we need to make sure is in there, if it's a basic account, we need to make sure that the custodian is going to approve this investment. So if it's a checkbook IRA, you don't need that because you're not going to get the custodian involved. If it's a solo 401k plan, you're not going to have some administrator involved that's going to say yay or nay, you can't do it. So if we're talking about a basic self-directed IRA, it's critical that the custodian, you put something in there stating that, another term of contingency, the purchase is the custodian's approval of this investment. One other comment on disqualified parties, and I'm sorry, I'm going back, I'm just so excited today, but go back and talk about who's a disqualified party. So I said lineal ascendants, descendants, their spouses, and other legal entities own a controlling interest by one of those. I did not say anything about siblings, aunts, uncles, cousins. So if you've got a basic account and you find that property you've got to buy and you haven't gotten it set up, the account established yet, have your brother or sister do it. Let them buy it or tie it up, and then it'll just be assigned over to you later. That's an easy way to take care of that prohibited transaction that would occur with a disqualified party involved with it. Selling the property. So what I'm going to tell you is that when you're going to establish one of these accounts, if you said, hey, I need $100,000 to go buy this property, I'm going to say put 120 in there or something. Have some extra money, because we want to make sure there's enough to make the purchase and cover any potential problems that might occur during the time you own the asset. So we want to make sure there's enough money in there to buy it and to cover carrying costs during that projected hold period. And it's critical we do that. If we're talking a checkbook IRA with one member, then we can have additional sources of funds, as long as the same type of money And what I mean by that, if it's Roth money, it's Roth funds, or traditional and traditional, we'll just move more money from another source into that account. So the money has to go from the old custodian to the new custodian makes another investment in that limited liability company. You cannot take a distribution straight from the LLC, nor can you make a contribution directly into that LLC. Either one of those is considered a prohibited transaction. And the extent of problem that is really exhibited by the fact that a lot of trust companies actually have an IRA LLC contribution distribution correction form that is supposed to clean that event up. But the bottom line is, don't do it, period. So when you're selling the property, you're just going to list it as you normally would. Just contact your broker, and you're going to have a listing agreement either between the broker and, if it's a basic account, that trust company for benefit of the IRA, or it's going to be between the trust company or the broker and the IRA LLC, or the broker and the solo 401k, depending on what it is. It's just a direct agreement there. And the sale is going to happen as normally would. When that sale closes, the proceeds just go back into the trust company. If it's a basic account, it goes back in the IRA LLC. If it's a checkbook IRA, or it just goes back into the solo 401k plan if it's a solo 401k. And that money sits there. And the beautiful thing about IRA money, anybody on this call that's been through a 1031 knows that it can be nerve-wracking. Things go fast. That 45, 180-day timelines go very, very quickly. One of the huge benefits of IRA and 401k investment is you don't have those timelines. So when the property sells, the money goes in the account, just sits there until you find what you want to buy again. And by the way, a checkbook IRA bank account, or the LLC, or the solo 401k bank account, really it can be just a checking account, it could be savings account, it could be both, it doesn't really matter. So the money, while it's sitting there, doesn't have to just sit there dead in the water. If you want to open Wall Street investments with funds out of your checkbook IRA LLC, you've got two choices. The safest choice is to move the money back from the LLC through the trust company back to your financial advisor's account. Therefore, the funds are segregated. The easiest way to do it is just to open a trading account in the LLC's name and EIN, and that way you don't have to move money back through the trust company route. It's just in your LLC, but whatever's going on there would be encumbered with anything else you've got going on with the checkbook IRA LLC. 401k plans, that's not necessary. You're just going to have a trading account in the plan's name and EIN. You're going to have that bank account to fund any investments in notes, loans, gold, so whatever you want. Even crypto and Bitcoin, you can do this stuff with a checkbook IRA or solo 401k. So the nice thing, like I said, is the money's just there, ready to jump on those opportunities. And as we were discussing at the very beginning, we might have some opportunities coming up in the coming months. And if you've got the gold to jump on them, it might be a very positive time for you. So how about a new business? Maybe you lost your job during this whole mess, and you want to go create a new business. Well, we can do that. We can do what's called a rollover business startup, and the acronyms are ROB, sort of unfortunate, but what we're going to do there is we're going to move money from your current plan into a new 401k plan. We're going to create a new C corporation. The plan buys the corp buys the business, and now you're going to be employed by a company. We require you to have 5% of the ownership, so 5% of the shares personally. But you're going to be working for a company owned by your retirement account, or at least partially owned by your retirement account. It can be any percentage you want with any number of investors in there. But if you've got a controlling interest, then we're going to use rollover business startup, and it works very well for people. This is obviously a topic that has going to take more time than we've got in a basic class today. So if you're interested in more information on this or some of the more complex issues, keep an eye out for a more advanced class on the IRA 401ks, and you'll get that information there. Few examples and we're done. So this is a situation, this happened during the last crash. All these are real transactions. This guy came to us from Bend, and if you look at what happened last time, we had just a total collapse, boom or bust town, right? So we had a collapse in the values of real estate there. And so this guy said, hey, I know at some point these lots are going to be worth a lot. You know, if you look at Pronghorn and Remington Ranch and some of these others, if you're in the Northwest, you probably know those names. You know, they went from worth a lot to not much. So we had this builder developer came to us and said, look, I want to use my retirement account to land bank. The problem we were going to have, though, is in the future, he was going to want to be able to develop that stuff. So what happened is we did checkbook IRA for him. He went out and bought the dirt. We did a second limited liability company for him, and he was a 1/6 owner of it. So we put other vendors in there. And what would happen is as he wanted to build stuff out, we would have that second entity buy from the first entity. Since he was a 1/6 owner, it was not a prohibited transaction. He didn't have a controlling interest in it. So that was all fine. And so he was able to just land bank, use the retirement accounts to hold the land until it was to be developed. And then as he developed it out, they just transferred development entity, sell it, and build it, sell it, and just keep rolling things through that way. And it worked very, very well for him. Got a question from a Jared Stash. Question is, if the property cash flows, does the cash flow have to go back to the IRA? Can the management company hold any cash flow in reserves for repairs? Great question. If you've got professional management, and I know, Jared, you do some of that, but you know, as far as the cash flow on the property, if you've got professional management, it's fine. Let them manage the property as normal. You're just going to have them do it like any other account. They're just doing it. They're going to have the contract. The business relationship is not between you and that management company. It's between the LLC and the management company, or the 401k plan and the management company. So the management company is just going to handle stuff as they normally would, and they're going to probably pull up some funds, and then they'll make distributions to whatever account it is. And you know, the other thing I'll say is we have people that want to take the cash flow to live on too. And they can do that, but I wouldn't do it monthly, because to take the cash flow, it's going to have to flow. If we're talking a checkbook IRA, it's going to have to go from the LLC back through the trust company to you. And every time you do that, there's some money involved, takes time. So I would probably pool it up, let it go quarterly or semi-annually, something like that. And that's how it's going to take care of it. But you know, with management, they're going to handle it like any other asset. It's going to be taken care of. If you are managing the assets yourself with a checkbook IRA, then obviously you've got the ability to take care of those things just with the checks. But you know, that's a great question, and just be aware of what's going on there. I have people call up and say, hey, I want to buy the apartment building. I need more cash flow. Well, that's fine, but you don't own the apartment building. Your retirement account does, and you're going to get the cash flow via a distribution. So just make sure you're aware of that, and that there's costs moving things back and forth. So this example, the guy came to us, and got a couple mobile home RV parks in there. I guess they're just popular right now for a variety of reasons. But in this situation, what happened is this guy's had a bunch of income property, a bunch of doors meaning apartments. Tired of the terrible teas, toys, trash, tennis turnover, didn't want any more of that stuff. So he was looking at buying this mobile home RV park, have it professionally managed, but then he reached out the next day, and he says, well, hey, can I buy notes? And we said, sure, certainly. And this was another transaction that happened during the last crash. And I just use these because I want to, show people the opportunities that may be around the corner for us again today. But this guy, his first transaction was a condo down there, and down in Palm Desert, that is, down there. And it was a condo that had been $250,000, and now it's being sold for, I think, $70,000, and it just needed $35,000, 50% loan to value, paying him 11%. And he just he had a mortgage broker that sold him these deals, and that was a very attractive thing. Everybody talks about all the stuff they own. Well, you don't own it till you paid it off, right? So, if you're the lien holder on it, I guess general rules are never anything but a first, and never for any more than you'd be happy owning the asset for. And you just keep those rules at heart. You'd be fine on this stuff. But ultimately, he started off. A lot of times, people get started in these things. They dip their toe in the water until they know what's going on. And he started with that first investment. He ended up rolling several $1 million through us in the self-directed IRAs, and all notes. And the best one he got was like I don't know, it was $900 and some odd $1,000 deal on a wind power farm, at first needing only $100 and some odd $1,000, paying him 19%. That was a home run, and in his words, he hoped that people defaulted on the stuff. But notes are very popular with our investors. Most of the time, people buy real estate. They do a lot of note work. Some people are flipping properties, doing different things. Some buy crypto, some buy gold, silver. I had an Intel guy. We actually did a rollover business startup for a gold, silver, palladium mine. But all kinds of things are out there and possible. So he, once again, got away from the shareable teas, got nice cash flow, all firsts, low risk, great returns, and that's what he wanted. So this gentleman, this was a big problem. Okay, this guy had a $3 million property. It had a $1.2 million lien on it, and he had a problem there because he was getting behind. He had bought it to develop, and now everything's dead in the water. And not only was he having a problem, but the bank itself that had the loan was going to go away. And if the bank went away, obviously his loan was going to go and the property was going to go away. So he asked, could I use Dad's IRA to pay off the property? And the answer to that question is no. You can't just take Dad's IRA to pay off a property. That's a prohibited transaction. So what we did is we created a new limited liability company. Junior put the property in, received an interest attributable to his equity in that property. And then at the same time, his father made an investment with the IRA funds into, so we did checkbook IRA for Dad, did a second LLC, and that second LLC was the entity that received the property and then received the cash from Dad's IRA to pay the loan off. So now that property was no longer owned by Junior. It was owned by that limited liability company that had the cash to pay it off, which it did. You fast forward a number of years later, and the thing got developed into an apartment complex. But that was an example of a situation where we had somebody losing a property, a real bad deal, and got them taken care of. This is just a situation where somebody wanted to take their money, go buy the apartment building. Years ago, we had somebody that was actually a Russian translator for the Olympics, and he was leaving for the Olympics like a week after he contacted us, and he had to get this thing done. And so we ended up getting it done, but we just had to race through to get everything handled before he headed out. But it goes back to the story. Take the time, understand, get ready. Anybody on this call that scuba dives, the deal is plan the dive, dive the plan. If you fly, it's same situation. You got a boat, you're going to take a trip, same situation. Plan for it, get ready, and then jump in. Don't get all excited, get things tied up, or try to get tied up, and then you get up over your skis and you got a problem. So take the time. This is your retirement, and you want to be cautious with it, and take the time to understand. Have the conversations with your tax people. Make sure they're good with everything too. If they've got questions, they can reach out. But this is just a slide exhibiting that people come in, and one thing's done yesterday, and it takes time to get you there. We've got one more slide, one more example, one other slide, and then I'm going to cut you free. So the final example is a Rob's situation. So what happened is this couple came to us, retired couple, each had IRAs, and they came in and said, well, gee, we want to go and buy a mobile home RV park. And we said, okay, fine, we'll do a checkbook IRA for the two accounts. So we do one LLC, have his account and her account both make the investments in the LLC, and then that entity would own the asset. Well, then they mentioned they wanted to be the on-site managers and live there. Well, we can't do that with an IRA. So that would have been considered a prohibited transaction. You can't do that. So we shifted gears in the rollover business startup. We took both their IRAs, moved them into the new 401k plan. The plan then bought the corp then bought the park, and these people got got an investment, got a job, and a place to live. And I just think that's an amazing transaction that really took a lot of things into consideration, got these people where they wanted to be. So, never say never. The only dumb questions one you don't ask. Give us a call, ask the questions. So, the IRA Investors Checklist. Plan ahead, takes 2 to 4 weeks to get this thing together. You can purchase all types of property with an IRA, SEP IRA, Roth IRA, 401k plan. You can purchase with family members and friends. You just can't purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage. Negotiate from the deal's inception in the IRA or IRA LLC's name. If you're a broker, really encourage your client to get the thing set up before you start working. It's going to make your life a lot easier. Do not overextend. Plan on keeping a nice cushion for reserves. And that comes back down to don't just have enough to make the acquisition. Anyone on this call that has real estate knows once in a while you have costs come up. Make sure you've got enough money to make the acquisition, cover any carrying costs during the time you own it. Finally, real estate is real investment, not an alternative investment. Thank you very, very much for your time today. I kept you 2 minutes over. If you've got questions and you didn't put them up there, I've got a couple that I didn't get a chance to get to, just to reach out. We'll get you information with, if you've got credit hour requirements in Oregon, we can provide you with 1 hour of CE for today. If you're in another state and you're looking for that, you can reach out and check in with us, and we'll check, see what we need to do to get you CE for that state. Other than that, I hope you found it worthwhile today. Hope you got a couple nuggets of knowledge out of it, and I look forward to speaking with you soon. And best of health to everyone out there. Thank you, David Moore. And once again, if you want CE, Celia in here is going to be reaching out, but you can reach her at cmoore, CMOORE @ 1031exchange.com. Thank you, and all my best to you. Bye-bye.